Something that was supposed to be permanent just cracked. Not in a way that made breaking news alerts, not in a way that interrupted your morning, in the kind of quiet structural way that the biggest monetary shifts always begin, underneath the surface in the decisions that institutions make before the public understands what those decisions mean. Let me tell you what happened. In April 2026, after 60 years of continuous membership, the United Arab Emirates announced its withdrawal from OPEC. That alone would be significant, but within the same window of time, almost simultaneously, the UAE's central bank issued a statement that should have stopped every serious financial analyst in their tracks. It stated that it might begin pricing its oil sales in currencies other than the US dollar. This was not a rumor, not a fringe source, not an interpretation of ambiguous data. Reuters reported it. The Financial Times reported it. Fortune reported it. The monetary authority of one of America's closest strategic partners in the Middle East said, on the record, that it is considering abandoning the arrangement that has structured global energy markets and underpinned American financial dominance for half a century. And most investors either have not heard it or do not yet understand what it means. Here is what it means. The petrodollar system, the invisible architecture that forces every country on earth to acquire US dollars before it can purchase oil, is fracturing, not from a single dramatic event, from three simultaneous pressure points that are compressing the same foundation from different directions at the same time. The institutions that manage national reserves already know what this means. They have been repositioning for years, quietly, methodically, in the data that almost nobody reads. Gold is already moving in response to what those institutions see. The question is not whether this is happening. The question is whether you understand it before the translation becomes obvious to everyone, at which point the opportunity has already closed. This is Capital Briefing. If you are here for the first time, subscribe now before we go any further. What we build here is not financial entertainment. It is financial intelligence, the kind that matters before events become headlines, before the crowd repositions, before the narrative catches up to where the smart money already is. Subscribe now, activate notifications, then let me show you the mechanism. Before I explain the three fractures, I need to give you the foundation, because if you do not understand what the petrodollar system actually is, not the name, the actual structure, you cannot evaluate what breaking it means. In 1974, Henry Kissinger flew to Saudi Arabia. The United States had just survived the oil shock that created gasoline lines around city blocks and an inflation spiral that threatened to destabilize the American economy. The Bretton Woods system, which had pegged the dollar to gold at $35 per ounce, had already collapsed 3 years earlier when Nixon closed the gold window. The dollar needed a new anchor, a new reason to be demanded by every nation on earth. Kissinger found it in oil. What he negotiated was not a formal treaty. It was a set of informal arrangements, a handshake structure that restructured the relationship between American monetary power and global energy in a way that has shaped every dimension of international finance since. 3 pillars. First, oil would be priced and settled globally in US dollars. Every country on earth that needs oil, which is every country on earth, must first acquire dollars to buy it. This creates a structural, permanent demand for the dollar that has nothing to do with the attractiveness of American assets or the credibility of American monetary policy. The demand exists because energy exists, and energy requires dollars. That was the anchor that replaced gold. Second, the petrodollar revenues accumulated by Saudi Arabia and the Gulf producers would be recycled back into U.S. financial markets, specifically into U.S. Treasury bonds. The dollars earned from oil sales would flow back to Washington as loans to the American government. This kept U.S. borrowing costs suppressed and created a permanent institutional buyer for American deficit spending. The U.S. could run fiscal deficits that would destroy any other currency because there was always a structural buyer standing ready to finance them. Third, in exchange, the United States provided the Gulf monarchies with military protection, weapon systems, political support, and a guaranteed security presence in the region. You price oil in our currency and recycle the revenues into our debt. We protect your governments and your oil fields. That machine, invisible to most people, operating continuously in the background of every financial transaction on Earth, is the structural reason the dollar became and has remained the world's reserve currency. It is what economists call the exorbitant privilege, the ability to import more cheaply than any other nation, to borrow at rates your fiscal position does not justify, to run persistent deficits without the currency crisis that would terminate any other country attempting the same. The petrodollar is not background noise. It is the engine of American financial power. And right now that engine has three simultaneous fractures appearing inside it. Fracture number one, the UAE's departure from OPEC. The UAE invested heavily in expanding production capacity, infrastructure capable of producing 5 million barrels per day. OPEC's quota system limited it to approximately 3 to 3.5 million barrels. For years, the UAE has been running a production facility at 60% capacity because its organizational partners instructed it to. The economics of that constraint became progressively untenable as the investment in expanded capacity grew. But the production quota is not the story. The production quota is the visible surface. The story underneath is that the UAE joined the BRICS alliance in 2024, the coalition of nations that has been explicitly building alternative trade and payment infrastructure designed to reduce structural dependence on the dollar. And the central bank statement about potentially pricing oil in renminbi is not theoretical. China is the UAE's single largest oil customer. The commercial logic of pricing sales in your largest buyer's currency is straightforward. The geopolitical logic of reducing dollar dependency in a period of regional instability is equally straightforward. Both logics are pointing in the same direction at the same time. That is not coincidence. That is a structural calculation reaching its conclusion. Fracture number two, Saudi Arabia and the renminbi negotiations. Saudi Arabia is the anchor of the entire petrodollar system. It was Saudi Arabia's cooperation with Kissinger in 1974 that created the architecture. Without Saudi Arabia, there is no petrodollar. Saudi Arabia is in structured negotiations with China for long-term oil supply contracts priced in renminbi, not preliminary conversations, not exploratory meetings, structured negotiations for agreements covering 10 to 20 years. If those negotiations conclude successfully, the foundational pillar of the petrodollar, that oil is priced and settled in dollars, will have been compromised at its origin point. The broader pattern extends across the region. India completed its first rupee-denominated payment for UAE oil this year. Russia, effectively expelled from the dollar system through the 2022 sanctions architecture, has been trading energy with China, India, and willing partners in local currencies for over 2 years. These nations are not making symbolic gestures. They are making rational sovereign decisions in response to a specific event that changed the risk calculation for every treasury ministry on the planet. In February 2022, the United States and its allies froze $300 billion of Russian central bank reserves. Every central bank and treasury ministry on Earth conducted the same risk assessment in the days that followed. The question was not whether Russia's actions justified the response. The question was, if our reserves are held in a system controlled by a potential adversary, are those reserves actually ours? The answer demonstrated by the Russian episode was, conditionally. Your dollar reserves are yours as long as your relationship with Washington remains acceptable to Washington. The moment that relationship deteriorates, those reserves can be frozen with a digital instruction to a correspondent bank. That answer, delivered with perfect clarity by a real event, not a theoretical scenario, changed the sovereign risk calculation permanently. The capital flows that followed that calculation are now measurable in reserve allocation data. They point toward gold. Fracture number three, the Treasury recycling mechanism is breaking down. China's holdings of US Treasury bonds have fallen by approximately 50% from their peak. This is not a portfolio adjustment. China was once the largest foreign holder of US government debt. Its deliberate, sustained reduction of that exposure represents a fundamental shift in the demand structure for American borrowing. Some other nations have partially offset this reduction with increased purchases. But the directional signal from the world's largest trading nation is not ambiguous. The recycling mechanism, the second pillar of the petrodollar, the arrangement that kept US borrowing costs artificially suppressed, is structurally weakening. In an environment where the US is adding approximately $2 trillion to its national debt annually, the marginal cost of financing that debt faces structural upward pressure that did not exist 5 years ago. The buyer that absorbed the excess supply for decades is systematically reducing its position. The implications for US fiscal sustainability and for the credibility of the fiat currency backed by that fiscal position are not theoretical. They are arithmetic. Now let me connect all three fractures to gold, because this is where most analysis misses the most important signal. The nations reducing dollar exposure are not moving into euros, not into yen, not into other fiat currencies that carry their own political dependencies and debasement vulnerabilities. Those are simply different versions of the same structural problem, with different national names attached. The asset they are moving into, in quantities that have not been seen in modern financial history, is physical gold. Central banks globally purchased over 1,000 tons of gold last year. Poland, Kazakhstan, India, China, Brazil, Uzbekistan, nations across vastly different political systems, economic models, and geopolitical alignments arriving at the same allocation decision for the same structural reason. After the Russian reserve freeze, every central bank on earth asked the same question. What asset cannot be frozen by a foreign government's executive order? What asset cannot be sanctioned? What asset cannot be made inaccessible by a regulatory instruction from a correspondent bank it has no relationship with? Gold held physically in domestic vaults answers every one of those questions. It has no nationality, it has no counterparty, it has no issuer that can debase it through policy decision, and it has functioned as a store of value for 5,000 years across every monetary system that human civilization has constructed and subsequently discarded. The Roman centurion's ounce of gold purchased a quality outfit 2,000 years ago. It purchases a quality outfit today. The dollar that was worth 100 cents in 1971 is worth approximately 7 cents in 1971 purchasing power terms. The comparison does not require elaboration. The central bank buying I described is not sentiment. It is not fear in the casual sense. It is a rational, long-horizon, institutional decision by the organizations with the most comprehensive understanding of monetary system risk. The people who manage national reserves, who have studied the history of every reserve currency transition in modern history, who have access to the most complete picture of sovereign financial vulnerability. When those institutions move from dollar-denominated assets to physical gold at a pace not seen since the immediate post-Bretton Woods period, they are expressing a considered institutional view about the long-term trajectory of the current system. The retail investor who dismisses that signal because gold does not pay dividends is making a category error. The institutions accumulating gold are not looking for yield. They are looking for monetary system insurance in an environment where the system itself is under structural stress. Now let me address the specific confusion that causes most retail investors to misread gold's price behavior, because this misreading leads directly to positioning mistakes. Gold does not primarily respond to fear. This is the most widely repeated and least accurate claim in financial commentary about the metal. Gold responds to real yields, the gap between nominal interest rates and realized inflation, to dollar direction, to liquidity conditions in the derivatives markets that overlay the physical market. During the acute phase of any geopolitical crisis, the period when conventional wisdom says gold should surge, several forces temporarily suppress it instead. The dollar strengthens as global capital concentrates in the most liquid reserve asset. Real yields rise as central banks freeze on rate cuts in response to inflation pressure. And leveraged investors holding gold through futures and leveraged ETFs face margin calls that force liquidation of precisely the asset that looks most attractive on fundamentals. This mechanical suppression is temporary by definition. It resolves when the leverage clears. And when it resolves, gold reverts to reflecting the structural forces that actually drive long-term demand. The de-dollarization trend, the fiat currency debasement dynamic, and the physical supply constraints of a commodity that requires years of capital investment to bring new production online. Understanding this distinction between the short-term technical suppression during acute stress events and the long-term structural driver separates investors who read the gold signal correctly from those who sell at exactly the wrong moment. Subscribe to Capital Briefing if this level of analysis is what you have been looking for. Every video we publish adds another layer to the same systematic framework, understanding where institutional capital is moving before that movement becomes visible in retail prices. The next video examines what central bank gold accumulation data historically signals about sovereign debt stress timelines and what specific positioning implications follow from that historical pattern. Subscribe now. Activate notifications. Then let me take you to the structural opportunity. Let me name the three forces supporting gold precisely, because clarity about the mechanism is the foundation of any positioning decision that survives the volatility between now and the structural resolution. The first force is de-dollarization, the systematic sovereign-level movement away from the dollar as the primary reserve and trade settlement currency. I have walked through the evidence: UAE's OPEC departure and central bank statement, Saudi-China renminbi negotiations, India's rupee oil payment, China's sustained treasury reduction, central bank gold accumulation at historic pace. These are not isolated events. They are coordinated expressions of the same underlying sovereign calculation, a gradual but measurable structural movement away from the dollar-centric system that was built at Bretton Woods in 1944 and reinforced in Riyadh in 1974. The pace of that movement is measured in years, not quarters. Its direction is not ambiguous, and its pace is accelerating in the current geopolitical environment. The second force is debasement, the continuous erosion of fiat currency purchasing power through monetary expansion driven by fiscal necessity. The United States is adding approximately $2 trillion annually to its national debt. The interest payments on that accumulated debt now rival defense spending as a budget line item. The only politically viable resolution to that arithmetic involves some combination of inflation and monetary accommodation that gradually reduces the real burden of the outstanding debt. Gold supply grows by approximately 1 to 2% annually through mining, with no possibility of policy acceleration. In an environment where the dominant reserve currency is being systematically debased, gold's supply scarcity is a structural advantage relative to every fiat alternative, not a historical curiosity. The third force is diversification. The rational portfolio responds to a world of accelerating geopolitical fragmentation, where concentration in any single currency or geopolitical bloc carries risks that did not exist in the same form a decade ago. Gold is the only monetary asset that provides diversification genuinely independent of the political relationships and financial system architecture that determine the value of every other reserve instrument. In the current environment, that attribute has moved from theoretically interesting to practically essential. Now let me be direct about the investment dimension, because this channel does not stop at structural analysis without translating it into positioning implications. Physical gold and unleveraged exchange-traded fund exposure is the foundational position for investors seeking direct exposure to the de-dollarization, debasement, and diversification thesis. It does not generate cash flow, but it maintains real purchasing power across monetary system transitions in a way that no fiat currency has historically matched. The relevant precedent: investors who understood the structural forces in motion in 1971, who held gold at $35 per ounce through the Nixon shock and maintained conviction through the volatility and criticism that followed, experienced a move to $850 over the following decade. Not because they were alarmist, because they understood the mechanism before the mechanism became obvious in prices. Gold mining companies provide operating leverage to the same thesis. A miner's revenue is set by the gold price. Its near-term costs are substantially fixed. When gold rises 25%, a miner's operating profit can increase 30 to 40%, depending on the gap between the gold price and its all-in sustaining cost. That operating leverage is the structural reason miners historically outperform bullion during sustained gold bull markets. The current environment, where the structural tailwinds are as strong as at any point since the 1970s, is the specific environment where that leverage matters most. Companies with the lowest production costs, the strongest balance sheets, and the most disciplined capital allocation histories will capture the operating leverage most efficiently. That is where the most asymmetric opportunity sits in the current cycle. Let me close with the structural observation that I believe is most important to carry forward from this analysis. The petrodollar system did not fail overnight. The 1971 Nixon shock, which ended the dollar's gold convertibility and initiated the modern fiat era, was the culmination of pressures that had been building for years. France had been demanding gold redemption for its dollars since the mid-1960s. Gold outflows from the Federal Reserve had been accelerating. The fiscal pressures of Vietnam and the Great Society had been mounting. The shock was sudden. The conditions that produced it were not. The fractures I have described today are the accumulating conditions. The UAE's OPEC departure, Saudi-China renminbi negotiations, China's systematic treasury reduction, central bank gold accumulation at historic pace. These are the French gold demands of 2026. These are the accelerating pressures that precede a systemic crystallization event. That event may not occur this year. It may not occur in the next several years. Reserve currency transitions operate on decade-long timescales, not quarterly earnings cycles. But here is what is not ambiguous: the direction of the structural forces, the pace of accumulation, the institutional capital that has already repositioned. The petrodollar is not dead. The dollar is not going to zero. The US financial system remains the deepest and most liquid in the world. Dollar dominance does not end with a press release. What is ending, measurably, documentably, in the sovereign capital allocation data published every quarter, is the unchallenged monopoly. The system in which every barrel of oil requires $1, in which every producer recycles revenues into treasury bonds, in which the exorbitant privilege operates without challenge or consequence. That specific architecture is fracturing under 3 simultaneous pressure points right now. The capital flows already responding to those fractures are measurable. The institutional positioning is visible in reserve data. And gold, the monetary asset that has absorbed every previous collapse of a paper currency system, is already pricing in what the institutions that understand monetary system mechanics have concluded. The question this analysis raises is not whether the shift is real. The data answers that. The question is whether you understand it before it becomes the consensus narrative, at which point the opportunity has already been priced into assets that today still sit at a fraction of what that structural transition implies. Subscribe to Capital Briefing, activate notifications. This is the analysis that exists between what the financial media shows you and what the institutional capital is actually doing. Each video we publish closes that gap by one more layer. Drop a comment. Tell me, which of the 3 fractures, the UAE departure, the Saudi-China negotiations, or the treasury reduction, do you think carries the most structural weight? And what would it change about your positioning if you took the central bank gold buying data at face value? The shift has started. The institutions already know. The only question is which side of that knowledge you are on before the translation becomes visible to everyone.